to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, 7 investors, and welcome to the Monday edition of 7 Investing Now. As you can tell, I am back at home in West Palm Beach, Florida, but it has been an odyssey. We will talk about that in a minute. My name, of course, is Daniel Brooks Kline. I'm the host of the program. I am being joined today by marvelous Maxx Chatsko and stunning Steve Symington. Max, do you know the origination of the marvelous nickname?
No idea.
So that comes from Marvelous Marvin Hagler, the rare boxer who made his money, was a great champion, lost a fight, and then stopped boxing, which is really the way to do it. Like if you could get hit in the head, but legally he went and changed his first name to Marvelous. So he could actually own this. Very similar to how the former Ultimate Warrior changed his legal name to Warrior, and his family actually goes by the last name Warrior, which are all things to get around copyright. And I am sure, Steve, you know where the stunning nickname comes from.
I thought we were just going anagrams. That's
no, that would be the original nickname of stunning Steve Austin back when he was a young wrestler with stringy blonde hair. But we're not going to talk wrestling. We're not going to talk nicknames. We're not even going to talk boxing. Now, I'm hyped up here. I'm excited to be here. We had a great week last week. We got a busy week planned this week. But as many of you know, I was in Birmingham, Alabama after being in Cherokee, North Carolina, all of which I had to do by car because Delta Airlines is the Comcast of airlines. They don't care if you get there. They still have my money. They didn't actually fly me anyplace, and that is somehow my fault and not theirs. And if I want to wait on customer service hold for 6+ hours, I can wait to be confirmed that they're not going to give me my money back. But that said, if I look a little tired, it's because yesterday I got up at 3 a.m., whatever the time that isn't Eastern and isn't what you guys have in Houston. Is that Central? Is that Mountain? I have no idea. I'm an East Coast, West Coast snob here. So I got up at 3 in the morning and then drove and got home at about 4 in the afternoon. So when you factor in the hour change, that is about a 12-hour drive. And why do I tell you this? Is because normally we plan a lot of this show on Sunday. But I took a look at the news and I messaged you guys and I got a quick response back from Max, I'll be on. And I went to bed at about 10 o'clock last night going, hey, at least I know someone's on the show. Doesn't look like there's any big news anyway. Max will pick some biotech thing. We will get through the show. And then, of course, I wake up to Steve saying he wants to be on the show. And, of course, some pretty massive news. Now, this is a news tactic that you usually do to hide something. And in this case, they don't want it to be hide, but Zoom is paying $14.7 billion to buy a company called Five9. This is going to be the second segment of the show. I'd never heard of this company. I literally, in the description, wrote privately held company before Googling them and learning that they were a publicly traded company. So to say that Five9, which is an inch taller than me, Five9 is a below-the-radar public company. They do back-end call service. So we're going to talk about that later. But we're going to open up the show with a bit of a milestone. We've talked vaccines, we've talked Moderna, we've talked a lot of biotech. But Max, Moderna has become a $100 billion market cap. Historically, that has generally been a bit of a brick wall, right?
Yeah, so it's only the 16th drug developer that's ever hit a $100 billion market valuation. And, in drug development, there is this natural limit to how big a company can get. It's not like a tech company, right? There's never been a $1 trillion drug developer. There's actually never been one $500 billion drug developer, and that's Johnson & Johnson. Everyone else is below that. Some companies that reach $100 billion valuation fall, and they're not a $100 billion company anymore. So it's very, very difficult to grow beyond that limit or that milestone. And in fact, only 2 companies ever that have reached the $100 billion mark have then outperformed the S&P 500. And some of the returns are actually pretty ridiculously bad. We actually have a graphic. If the great, amazing Sam Bailey could pull up graphic number 1.
Yeah, this graphic is fairly graphic if you don't like negative percentages.
Oh, look at this. Minus 400, minus 3, yikes. This is total returns too. So we're counting in share buybacks and dividends for all of these companies. This is from the day they reached a $100 billion market cap, and then the returns against the S&P 500. So only 2 companies have actually outperformed from that date. So Moderna has a pretty tall task ahead of it.
I'm predicting Johnson & Johnson, which will soon become Johnson & Johnson and GameStop, will, of course, become the first trillion. No, that is an absolute joke here. Max, that's the history. And it's all well and good. Tomorrow night is Game 6 of the NBA Finals, and I spent the whole morning watching ESPN, and they basically said only a couple of teams have ever come back from that. And that seems like it's projectable, but the reality is it isn't, because nobody had come back from 3-1, and then LeBron James did it a few years ago. So this isn't necessarily the trajectory for Moderna, right?
Yeah, so the reason that it's so tough to grow at a certain level is because to get to that valuation, a very high valuation for a drug developer, well, after a certain point, those drugs have declining revenue. So then every new product you get to bring to the market is just replacing revenue that's declining elsewhere. So it's really difficult to grow beyond a certain level, right? Usually around like the $30 billion to $40 billion in annual revenue mark. Really tough to get much higher than that for a drug developer. For Moderna specifically, it's the first company to reach this mark that's a platform company. So it's obviously working on mRNA tools and therapeutics, and it's going to have about $20 billion in revenue from the COVID-19 vaccine it's developed. That's this year anyway, the expected revenue total this year. Maybe it can, hang out around that mark for the next couple of years, but it does have a broad tool that it can use in a lot of different therapeutic areas potentially, right? It's already exploring the use of mRNA, maybe a flu vaccine, an HIV. So that looks a lot similar to kind of what the COVID-19 vaccine looked like. And then it's also looking at, other uses of mRNA technology, maybe in cancer, maybe in genetic diseases for gene replacement and so forth. So it has the potential to expand much more broadly than any other company that's come before it that's hit this valuation mark.
Max, so you have another graphic here, which we should probably introduce as we move on here. And you're going to explain how genetics work, which gives you, genetic medicines work, which gives you a little bit of an insight as to why this platform could really be so versatile. But even then, I'd be a little bit wary, and we can talk about that as you bring up the graphic here. Thank you, Sam.
Yes. Oh, okay, perfect. So how do genetic medicines work? So we see here, for the first time, all these tools that we have coming at our disposal, right? Gene editing, base editing, RNAi, mRNA specifically would be for replacement and even maybe activation too. So we see here it's the first time that we've had the ability to act on DNA and RNA to affect protein function or levels. So this is why they're so valuable, right? And I think companies broadly would have genetic medicine platforms could potentially buck this trend and become much larger, than the large companies today, the Johnson & Johnsons and the Roche and the Mercks and so forth, right? They kind of more have like individual drugs in certain indications. But if you have like a mRNA platform and maybe a gene editing platform, you can potentially use that in many, many diseases.
So Max, if I create a drug, let's pretend Steve and I pioneer a drug, and it lets anyone who take it once grow 3 inches. That would be an incredibly, everyone wants to be taller except Steve. That would be an incredibly valuable drug. I'll also point out that
I'd be a giant by then.
I will point out that if we're all 3 inches taller, that changes nothing. I still can't see at a concert. But let's pretend this drug exists. Now, the negative is we only have exclusive rights to that drug for a certain period of time, right? And then eventually there are things I can do to prolong that, but eventually it becomes a generic. The price goes down. You still make money as the brand name holder, but obviously your pricing power goes down. Is something like an mRNA platform, is that something you can own and control for a longer period of time?
Yeah, I mean, there's other companies exploring mRNA, so there's nothing really exclusive to it. And that's kind of true of a lot of genetic medicine platforms, right? Like, we see dozens of companies in gene therapy, for example, right? There is like IP around like CRISPR specifically or uses of it or RNAi, but in general, there's like broad access to those tools. So, in a way, there is going to be a lot of competition. Like you said, there's constant innovation, the competitive landscape, and yeah, eventually drugs lose exclusivity. So I actually have notes here. Forgot how well prepared I was for the show last night, and then I kind of forgot about it. So only 9 drug developers have annual revenue of at least $40 billion. Only 3 have annual revenue of over $50 billion. So for comparison, just to show that this is not, drug developers, not tech companies, Apple AirPods, that one single product generated $23 billion in revenue last year, right? Now that's an extreme example perhaps, right? That's more than most companies generate. But it shows you like, even though scale gives you advantages as a drug developer, it does have limitations because eventually, that revenue is declining.
So, Max, as an investor, do you think Moderna could break this trend, or is it the reality when a company hits $100 billion, maybe that's time to sell. Is that like, maybe not a full-on brick wall, but you got to be like Mr. Kool-Aid to get through it, and there's just not that many Mr. Kool-Aids?
Yeah, I think it's possible that Moderna can outperform the S&P 500 from here, right? It actually just got added to the S&P 500 index, so that's nice. A lot of funds will have to go and change their positions and their holdings to include Moderna now if they didn't already own it. So that's a positive. It kind of creates like a floor almost, right, for the share price. So it's certainly possible that the company can outperform the S&P 500 from here. But when people give examples of how broadly we can use mRNA technology, right, there is a lot of nuance to consider. So first, in the near term, the next several years, it is going to be really difficult for Moderna to keep up its revenue levels at the $20 billion mark, right? Sure, maybe it can sell internationally. It's talking about boosters. You already know, if you're listening to the show, I don't think we're going to.
And you're talking specifically here that the vast majority of their revenue comes from the COVID-19 vaccine.
100% of their revenue.
Oh, geez, that's a lot. That is clearly the vast majority. So if we need a booster, theoretically their revenue could be somewhere in the 50% ballpark. If we don't need a booster, which you don't believe we will, and many doctors don't believe we will, their revenue, it won't go to zero because there will always be unvaccinated people taking the vaccine. But it could go to it could go to the box office for Black Widow in its second week, where there's just much, much less interest.
Right. So, they're generating a ton of revenue now, and that's good. And that, they're monetizing their success from helping the world in the pandemic. So that's good, right? Maybe they deserve to do that. We can argue about profits and all that, but that's another discussion. So that's good. That provides a lot of funding to advance other programs within its pipeline. But those are such, in the early stages of development where, those are going to be years away from generating any meaningful revenue. They have to go through, traditional clinical trials. They're not going to get emergency use act authorizations. And, we don't need any of those in 12 months, right? So it's going to be a much longer development timeline. And it's important to point out too, like, you see like in the, like the mass media, right? You'll see examples of like, mRNA technology is moving into cancer now. Well, that's a much different use of mRNA, right? So when I give you a vaccine for COVID, I just need to inject a part of the, the spike protein for the coronavirus into you, so your immune system, sees it and starts to, develop defenses against it. For cancers or genetic diseases, it's a lot different. I don't just need to put that mRNA into your body necessarily. I need to put it into the correct cells. So now there's a delivery challenge. It doesn't have to get in your bloodstream. It may have to get specifically to your liver, specifically to your lungs. So that's like, orders of magnitude more challenging. So don't be, deluded into thinking like, oh, it worked in COVID, it's going to work in cancer and HIV and all these other things. Much more challenging development ahead for this company.
And Max, let's go back to the comparison to technology here. I'd argue it's also comparison to, say, fast food or really any branded thing. So if I'm Apple and I say, I'm going to launch an Apple car or an Apple hoverboard or an Apple doorbell or whatever it is, there's a certain amount of Apple enthusiasts that are at least going to consider that product. Now, if I've had the Moderna vaccine and it went well, there might be a very tiny part of me that if they had another drug went, hey, I kind of trust Moderna, but that's not really how it works, right? There's no brand loyalty. Nobody's like, I had the Moderna vaccine, like, what else you got? So they're kind of hurting from every time you launch a product, it's on a completely blank playing field, aside from whatever marketing or salesperson advantage you have, right?
Yeah, there's really no ecosystem advantage, right, in drug development. Now, mRNA makes a lot of sense for flu vaccines, and we can't make a flu vaccine that would work broadly in for many years necessarily, right? Even if it's mRNA. mRNA just means it would be easier to manufacture. We could do it more quickly. Maybe it would be a little bit more effective. But the differences between, the genetic differences between influenza and coronavirus also suggest there's going to be much more, it's way more complicated. So you do have to acknowledge that when you're thinking about, we're just going to use mRNA for the flu. That's a little different.
Yeah, I'll throw out another quick example here, and we would love your questions and comments. Doris and Renee Cronell, we appreciate you saying Delta, oh hell no, never ever in years. Yes, that's how I feel. It is tricky to get places now. I will say I will never fly Delta again for a quick window flight. The customer service simply wasn't there. I understand things happen. I once missed a concert I was really excited to go to due to weather, but some airlines, Southwest and JetBlue, actually care that you missed the concert, and they'll do their best. I did not feel that way. But in this case, Max, so I'll bring this home a little bit more. Our marketing director, Sam Bailey, is wearing a Peloton t-shirt today. I think it's not unfair for me to say that. If you don't work at Moderna, you're not wearing a Moderna t-shirt. So is it possible that many of the companies you've recommended, and we'll talk about our picks a little bit, not specifically, but how they work later on, that you're picking these pre-revenue biotech companies? That's kind of your specialty. It's not all your picks, but it's a lot of them. And I own every one of them. That when they get to a certain level, maybe it's 50 billion, maybe it's 75, maybe it's that 100 billion wall, is that kind of the sell signal? Because it looks like 99 times out of 100 that, and I'll point out, Johnson & Johnson's a pretty broad company beyond just drug development. Like, so, you know, to me, that actually seems obvious that there's a certain point where your upside is just not there anymore. And maybe with Moderna, maybe there's no upside anymore.
Yeah, generally that is true, right? So most of the companies I recommend, even if they have recurring revenue, they are smaller, right? And that's just because of that natural limit. You know, when drug developers get into like the tens of billions of dollar valuations, very rarely do they tend to outperform from there, right? You almost have to be early on and then just be a long-term investor in order to really have success within drug developers. As you mentioned, Johnson & Johnson and Roche, so those are the 1 and 2, largest drug developers in the world. They generate a lot of revenue from other things. You know, Johnson & Johnson from personal care products. Roche has a giant diagnostics business as well. So those have diversified in other areas of healthcare, personal care, as a way to offset their declining, drug revenue. That's just like one of the limits of being in this space. So yes, you're right. There is like a natural limit somewhere in the tens of billions of dollars. Tends to be tied to specifically, annual revenue that you generate. So Moderna it's going to be a tough act to follow. It's going to be a while, I think, before it really gets to multiple products capable of generating $20 billion a year in annual revenue. So there is going to be a big dip in the next few years, I think, if the COVID-19 vaccines, wane in terms of their importance or how many they can sell. And again, there's international orders and supplies, I'm sure, but we are going to see a big dip in revenue. And then it's up to all those other products in development, which are still years away, to really kind of, live up to these high expectations now. So I would definitely not expect Moderna to perform very well in the next few years. Right now, there's still a lot of hype as well. So I don't know. I would not be going. I'm not going anywhere near this.
So we talk a lot about sell a stock when your thesis has played out. And with tech companies, that almost never happens. There's always sort of a rolling basis when the thesis goes on. It's possible, maybe even probable, that in the biotech space that there is kind of a hard wall at 100 billion where it's just not going to make sense to own. There will be exceptions to that. But in this case, there are better opportunities. How do you get those opportunities? Max, what do we do at Seven Investing? How do they get your picks? What is your pick? Is your pick like a favored restaurant to go to? What do members of Seven Investing get each month? But this is where we seg into the slight commercial part of the program, if you have not noticed.
Yes, on the first of every month, the 7 lead advisors here at Seven Investing, that's why we're called Seven Investing, each recommends their best stock market opportunity that month at that time, right? So you get those recommendation reports at the first of every month, and then from there we provide continuous coverage as long as that pick is on our scorecard. And spoiler alert, we're long-term investors. We've never recommended a sell yet. All of our picks are at least 3-year picks is the time frame we provide, and some are much longer. So if you want to get access to our picks, you can email Dan. Dan, you're going to give out your personal email address right now.
Oh, no. You should give out my home address. They should drive to the house. No, you should join us at 7investing.com/subscribe. What does it cost? That is a good question I just asked myself. It is $49 a month or $399 a year. That is an incredible value. So Max mentioned company updates. Now, if you pick an early stage biotech company, you might have multiple de-risking events or interesting news events in a quarter. Most of my picks tend to be mid-stage or even higher than that, retailers, but I have a couple of companies in there that are pretty high risk, pretty early in their development stage. So sort of the earlier it is, the more likely it's to be updated. This is not one of my picks, but let's pretend I picked Walmart. I'm just picking the biggest retailer I could think of. Well, not a lot can happen to Walmart. Even if like a person dies at a Walmart on Black Friday because they got trampled, that's actually probably not going to make a material long-term difference. Or if there's like a E. coli recall at Sam's Club, which has happened periodically, that is not really going to change Walmart's trajectory. Whereas if I pick some retailer that has 75 locations, much more likely for small news to have a big ripple effect. So it's not always like that, but some of these companies you're going to update once or twice a year. Some of them are going to get updated multiple times in a month. And of course, our members get access to our members' call. So let's say I've made a pick and I haven't updated it, and you wonder if I've lost interest in it. You can ask at our members' call, and I will literally just say, oh no, hey, I still love that one, and here's the next thing I'm watching for. Here's the next milestone or road point. We've seen a phenomenon in retail. And again, we'd love to take your questions and comments. We're going to talk about the Zoom purchase in a second. Stock Investor, I see your question. We're going to take that at the end of the Zoom segment. But we've seen a phenomenon in retail, MySpace, and a little bit in tech with the mature companies, with your Microsoft and your Apples, where they put out a great earnings report, and then the market goes, yeah, but they won't equal that next year, and the stock goes down. That is like being the worst kind of parent. That's like, Steve, your kid comes home, he's like, look, I got an A. And you go, oh, you're probably not going to get an A in the next test. Like, that is abusive. That is not great. And that's what we're having happening. We're having these short-term noise of stock analysts that don't understand that there are metrics beyond same-store sales, that you're right. Maybe some of these companies won't equal. Apple has an every other year cycle with the new iPhone. They have a soft update and then a hard update when the model number changes. They do better in the model number years. But if in the off year, they're adding to their service revenues and other things are going well, that doesn't mean Apple stock won't appreciate. And I believe Apple just hit $1.5 trillion. So, we are really in a case here where short-term doesn't matter. And that's what we do at Seven Investing. We are long-term investors. We are stay the course. We don't care that the market is down, whatever crazy amount it is down today, 500-600 points last I looked, because here's the reality. Nothing changed about any of the stocks we bought because there's a little bit of fear over the Delta variant. You're right. There might be some mask mandates. There might be some closures. That might create some hiccups. Doesn't change anything for good companies. Look, could be a death knell for some struggling ones. But in general, we're picking really, really good companies. Let us move into the next segment here. Steve, as I mentioned, went to bed last night, little cursory check of the news channels, didn't see anything. Sunday night is often where like you drop a bad story. That could happen on Friday night too because of the news cycle. It's like, oh, like our CEO was doing improper things with his babysitter. Like let's drop that one on a Friday or a Sunday night where the news cycle might not capture it. That's not what happened here. So this suggests to me that this is actually honest news, that the deal closed and they just released it as soon as they were obligated to. But I'll let you give us the 10,000-foot takeaway. But let me just explain what happened. Zoom, we all know Zoom from video conferencing, Zoom from very uncomfortable family get-togethers where there's always someone who doesn't know how to get in and an aunt or uncle who is on mute or one who has some really weird angle that's not great. We all know what Zoom is. It's become an important part of our lives during the pandemic. Zoom has bought a company called Five9 for $14.7 billion. That's the second biggest tech acquisition this year. The first was by Microsoft. Steve, what did they buy and what does this mean?
So Five9, ticker FIVN is that, and Zoom's ticker is ZM, if you're wondering. And it's funny because Five9 shares are only up like 5% because Zoom fell on the deal. In part because broader market's pulling back pretty hard, but B, that all stock transaction. So it will be a dilutive transaction, valued Five9 at about $200 a share based on Friday's closing price. So a little bit lower now because of the all stock transaction part, but about a $14.7 billion purchase by Zoom. So Five9 is a contact center as a service company. They're basically, it's a cloud-based contact center for customer service, right? And it's been interesting because Five9's kind of been enjoying some nice momentum in recent quarters, and the CEOs basically said it's been a lot easier to close deals because you no longer have to convince companies that transitioning from a legacy contact center platform to a cloud one is a good idea. It's pretty easy now. They just kind of step right in, and Zoom.
Steve, let me jump in. Does this just mean that, like, instead of all the people sitting in a room, they're just using distributed services across the cloud, and the actual people, I know there's an AI level to this as well,
Yeah.
but when you actually get to a person, that person just doesn't have to be sitting in a warehouse, whether that be in the cheapest part of Texas or the cheapest part of India. Like,
Yeah,
this isn't that revolutionary. Like, Amazon
Matt,
has done this.
big oversimplification, but yeah, yes and no. I guess Five9, they do incorporate a fair bit of artificial intelligence into their solutions and supplementing with chatbots and such. So it's a nice streamlined cloud-based solution for contact center service. So yeah, that's kind of where Zoom stands, and it's interesting because you think, well, how does that? I think that's maybe what might have been one of your first questions is like, what's the point? Why? How does this complement?
Yeah,
Zoom?
they don't seem to complement each other. So why don't you fill in? I understand that there's some back office complements. You can sell more products, but this seems to me like it's not like Zoom went and bought something that you go, oh, that's, as a Zoom customer, like, I'd love to have access to, a Slack-based service or whatever it is. This feels like it's kind of, they're missing like another piece of the puzzle.
Yeah, and there's going to be some inevitable comparisons to Salesforce and their acquisition of Slack, right? And Slack is kind of the messaging direct.
Steve, why don't you bring up Stock Investor's question?
Yeah, and that's what I was going to say. Stock Investor said, with acquisitions being made by both parties, Zoom and Salesforce now going head to head. Yes, sales, yes and no. I mean, they're crossing paths in a few places now. Salesforce does have a contact center solution. And Zoom made it a big point to mention that this is a $24 billion annual market that they're basically tacking onto their existing ones. And Eric Yuan, CEO of Zoom, in the blog post announcement this morning, he called it a natural fit and said he'd be able to deliver more value to customers and enable them to create the customer engagement platform of the future, right? So this is a very enterprise-centric acquisition. This isn't something like a consumer-facing, calling your grandkids on Zoom kind of thing. Enterprise clients are going to enjoy this. But Zoom also has their Zoom Phone product that basically replaces traditional hardline phones. And that's still a thing at a lot of enterprise customers, and they're looking for a better cloud-based solution that will be superior to their legacy kind of phone line systems, and to be able to integrate those phone line systems into like a call center model that's basically cloud-based, so you can get people to the right places and move them around that way. And I think that's the most important point, actually, that Juan in his Eric Yuan in his blog post this morning really noted that they've seen very strong demand for Zoom Phone, which is their cloud-based kind of phone system acting as a digital alternative to those legacy systems. And again, this is focused on enterprise customers, not consumers. And that's where Five9 is really complementary to what Zoom's trying to accomplish. It's complementary technology, but also gives them cross-selling opportunities between their customer bases. And if you look back at Zoom's last customer, the earnings transcript, read their call transcript. Management noted that at the end of last year, Zoom Phone, just a couple of years after release, had reached 1 million paid seats at the end of 2020, and 5 months later, they're at 1.5 million. So as I think the end of May, and they said they had like 21 customers with over 10,000 Zoom Phone seats. So growing pretty quickly, and it's something that is definitely complementary, and noting they've been partners for several years as well. So it's sort of like, well, why don't we own you? And that's the
so I'm going to argue that the Zoom Phone thing is very pandemic driven. I will also point out, if you have any broader market conditions, I don't want to minimize that the market is not doing great today. So if you're watching the show and you have questions about what's happening in the stock market today, you want us to hold your hand, feel free to put questions in. We appreciate you watching, but of course, we're always happy when it's interactive. But Steve, back when I worked at Microsoft, which was the launch of Windows 8, so we're talking almost a decade ago, if not longer than that at this point, we had what was called Microsoft Link, which is now Microsoft Teams, and that was our phone system because we were largely a distributed workforce. Slack offers exactly that functionality, and I understand that there is a layer you can add to that with answering systems, and when you literally don't have a legacy system. But a lot of companies, when they move to an out-of-office model, I assume they're using that to just get rid of this. Like, I don't know. Like, is the growth of Zoom phone something you're like excited about, or is it just like a byproduct of the fact that we're not near our physical phones?
I think it's a natural extension of their existing platform. And, make no mistake, this acquisition is going to kind of put the onus on Zoom to prove that it was a good move. It adds some integration risk. I think it really was maybe a best case scenario for Five9 investors. You look at this, it's a decently fast growing addressable market that Five9 was addressing, but it is narrow. And I think they were better served to be part of a broader platform like Zoom. So maybe a better move for Five9 to be acquired than Zoom to be acquiring it. But hey, Zoom's going to try their best to prove everyone wrong. So
I agree with that fully. We're going to go to Maxx in a second here. Maxx has a question for Steve, but I want to throw out that sort of the Salesforce model is we buy things that we can then sell to our customers. And I sort of like that from a Zoom point of view, because we might be at an inflection point where, and I'll give an example. The place we used to work has a big customer service group. And that group used to sit all in the same room. And obviously they don't all sit in the same room anymore. Maybe they were distributed between a couple of offices, but for the most part, they were all in the same place. And I think that's true of a lot of companies, your T-Mobiles of the world, even your Comcast, your companies with terrible customer service, your airlines. They've had these physical things, and the pandemic has forced that externally. So I think what Zoom is banking on, and Steve, I'll let you comment before Maxx asks his question. Yeah. I feel Zoom is literally looking at its customer base and going, I bet these people that are big Zoom customers are figuring out with this transition. And if we call them, why wouldn't they use ours? Though I have to assume, and I don't know anything about this space or Five9, I have to assume that there are other players that have solutions here. And then frankly, you can do a lot of this through Google tools if you're not a giant company. But is that the idea here, Steve? Just like, yep, we get a Salesforce, we get a customer base. Here's something else we can sell you.
Yeah, I think that's part of the idea, right? And I guess it's kind of hard to blame Zoom because they have kind of a nice currency, so to speak, with their soaring stock. And for perspective, let's zoom out a little bit. And, look at Zoom. I think Zoom was about Five9's size, the valuation, right? Just a few years ago. And, but even after pulling back, I think it's like 37% from its peak last fall. Shares of Zoom have still quintupled since the start of 21. So again, hard to blame them for going shopping with this stock because it dilutes their existing shareholders a lot less than it would have a couple of years ago to really accomplish the same thing that they might have considered doing back then, but it would have been a heck of a lot harder to pull off. But it makes sense, I think, relative to using its cash on hand to make the same acquisition. And it's much harder to do these kinds of things organically than it is to custom engineer a solution for a business that already has it when there's a perfectly good $15 business up for grabs, right?
That would be $15 billion business, of course. Yeah. And I would argue, and Maxx, again, I'll let you jump in after I say this. I would argue that Zoom has to buy stuff because the reality is Zoom's customer acquisition going forward has to slow down. Most people who have Zoom, and they might actually use it less, and some might downgrade plans. I would have preferred to see Zoom buy Slack back before Salesforce did. I actually thought that was a very smart integration. I wouldn't be against seeing Zoom by a hardware company. They put out the Zoom standalone device, and maybe you didn't even miss that, but I looked into it and it didn't even have a headphone jack. Like it was really a device that was only going to work the way like Facebook Portal does, which is like a very limited audience, as opposed to like, I thought like, wow, it'd be great to have a broadcast device back when I was broadcasting on Zoom. That's not what we're using for this show. I think there's a lot of opportunity in that space. Obviously, we've seen that acquiring is better than creating when even like Microsoft has struggled to get traction for any of its devices. But Maxx, you had a question for Steve. I will let you close this topic out here.
Yeah, Steve, how should Five9 shareholders feel about this deal? Because a $15 billion valuation is not actually that big of a premium to where it is now. No. So shares have like tripled.
About 13%.
Yeah, so shares have tripled since the beginning of 2020. You can't complain about that. Right. But if this is so important to Zoom, I mean, why didn't Five9 try to, finagle a higher valuation there?
Maybe like a 35% bump, like would have been nice for them. Like if I was a Five9 investor, I'd be kind of disappointed right now, because this is valuing the company at, based on Friday's closing price, and Zoom's pulled back a little bit. So, 5.9's pop today wasn't as pronounced as maybe they thought it might be, but that would have been a $200 per share valuation for 5.9. And I think shares right now are trading about 189 after like a 5.5% pop today. So pop. But yeah, I'd be mildly disappointed, but maybe, it is the best thing for the company itself. And it's rallied pretty hard. But I think, maybe you get a little bit of shareholder pushback that they maybe should have fought for a higher premium.
Steve, I have to wonder how many suitors there were. Because if you're a company that wants to bring this inside to run your own platform and not necessarily double down on new customers, well, you could build it for much less than what this costs or license it. Like there's a million ways to do this.
Sure.
In customer acquisition, if you're a standalone company and you're competing against the Microsoft, Google, Salesforce, again, I don't know who has exactly analogs to this, but there's definitely other people in this space.
Yeah.
I wonder if at some point your cost to acquire a customer is very daunting, and that what we're seeing here is this is the fourth part of the story, and the second and third part haven't happened yet. Like, I wonder if there are smaller acquisitions that are going to be connective tissue that make this make a lot more sense.
Yeah.
I could see some back end, I could see some fulfillment. I'm not sure what that would look like. Roll this all together and sell it to somebody bigger. I've often thought Zoom would make a lot of sense as part of something bigger.
Yeah.
God knows Google has not been able to do a good job with video meetings, though the history, obviously Microsoft bought Skype and then still developed its own thing because they did a bad job of integration. So Steve, do you think that's possible, that we're sort of, we're getting a little sneak peek of an advanced chapter, but we actually haven't seen, all the other moves that are going to unfold here?
I think it's more likely that Zoom has broader aspirations, and they might make some smaller acquisitions to complement this one to build up their own business. But for another company to step in and make an acquisition of, Zoom as a whole after it absorbs 5.9 and whatever other smaller companies to make sense, that would be very difficult. Considering Zoom's current market cap stands around 100 billion today, and there are very few companies that could pull that off. But I guess when you consider your Apples and your Amazons and your Googles and all of those that are $1 trillion, $1.5 trillion market capitalizations, and in some cases more than 100 billion in cash on their balance sheets, it's possible. But yeah, I think Zoom's going to try and go it alone, and I think they've long wanted to be a lot more than just a video conferencing platform, and I think that's what we're seeing right now.
And I will say it's hard to bet against Eric Yuan. He's really been an excellent CEO during all this. There were some, he had to deal with things that you never deal with, going from like 10 million customers to 100 million customers in like a bat of an eye. That would break an awful lot of companies. We've seen internet problems and outages and other things. And basically, we saw Zoom have a press conference where they said, yeah, we're going to stop adding new features for 90 days and just focus on growth. And that's almost the last you've heard of it. You don't even hear about Zoom bombs and other security issues anymore. So I really think nobody could plan for that. Like, Max, if you're biotech companies, many of which I've invested in, all of a sudden somehow stumbled upon something that fast-tracked through the system, because it just every step of the way, and I know it can't fast track that much, but every step of the way it worked, and it solved a really big problem. If it hadn't been really big companies that figured out the COVID vaccines, obviously they have to outsource to other people. They have to find ways to make it. If you're a small company that hits upon something, and Zoom is a relatively small company that, 10 times, then 100 times in terms of users, that is not easy to do. So again, I'm not sure I see the strategy here. I don't think I want to own Zoom. I've never owned Zoom. It always felt a little like 5 years ahead of itself in terms of stock price. But don't bet against Eric Yuan. We appreciate so many of you watching. You're all being quiet on this show, but we can certainly deal with the occasional one. It's very strange to me how sometimes there's like 8,000 comments and sometimes there's 4. So that's all right. But we love to be interactive. On Wednesday's show, I'm going to have Simon Erickson on. And one of our topics, we are going to talk about the best advice we've gotten from family. And it isn't necessarily someone sits you down and Max and says, well, Max, you need to be investing in plastics. It might just be lead by example. I shared this on my Twitter, @WorstIdeas7. We retweeted it from the @7investing tweeter. And the example I gave is when I was a kid, I saw my father leave the house at 6 a.m. every day, 5 days a week, and then at 7 a.m. on Saturdays to go to work. And he didn't come home till 5:30, 6 o'clock at night. And he only worked a couple of miles away. And on Saturday, he didn't come home till 3:30 in the afternoon. And my grandfather, who owned the company and was ostensibly wealthy, same example, was always working and always pushing ahead and always growing. And no matter how bad I was as a student or how sort of like other mistakes I made, I sort of saw like, oh, when you go to work, you work. You figure it out. You can push through. So feel free to jump on to our Twitter, and Max and Steve can retweet those and share the lessons you learned from family. They don't have to be good lessons too. I've also seen the impact of not being the hardest worker from some of my relatives who will go not named. So that's going to be part of Wednesday's show. On Friday's show, Matt Cochran is going to join us, and we are probably going to check in on some of the streaming companies, maybe take a look at the very, very bizarre box office patterns we have going on now. Why don't we jump in with one last comment from Scott Eigberg? Steve, if you want to read that out loud, that would be great.
Sure. He says, when you look at the totality of your portfolio 5 years down the line, what percentage of your stocks do you expect to, one, outperform, track with the market, underperform, or bomb/tank?
So I think that's very different depending on your portfolio. So yeah. I would argue that in my non-Maxx and Dana part of my portfolio, every stock I buy, I expect to in 5 years outperform the market. Maybe not everyone. There's one or two I've picked that have some risk, but I am generally picking companies where enough of the story is unfolded that there might be short-term negatives, but that's very not true for Max. But Steve, why don't you weigh in first, and then we'll let Max weigh in.
Right. Yeah, I've heard it said and written all over the place that if you're right more than half the time when you're trying to pick stocks to at least outperform the broader market, and by the broader market we're talking about the S&P 500 in most cases, that if you're right more than half the time, you're pretty darn good at this. And what you find with portfolio selection and portfolio outperformance is that a few really big winners can offset a whole lot of losers, right? And if you have several really large winners, then you'll see your returns pretty markedly outperform. So, I'd say if I'm right 60, 70% of the time, I'm doing pretty darn good. And you're going to have some that will underperform the market. I should hope that you have very few that totally bomb or tank. And if you've done your homework, you can really minimize the chances of that happening. But I'm not too concerned with a few underperformers in these early stages, as long as my outperformers significantly outpace them. And that's how kind of investing works. But
I'll jump in and say, like, if you're investing in earlier stage companies, and Max, I'll let you weigh in here, then you're accepting that some of them are going to fail or combine or get bought out, at way before the story is told. So, Max, I'm going to guess if you have like a good average for a baseball player, you're probably doing really, really well. Not a Pirate. A good average for a Pirate would be like 184 based on that game the other day. Up 6-0, lost 7-6 to the Mets, which is just embarrassing. And SD, we will take your question next. And if anyone else wants to sneak in before the end, we do have a couple of minutes here. But Max, if you're hitting 320, you're probably doing pretty well in your space.
Yeah, so to bring it back to the top for this question, it depends on how many stocks are in your portfolio, right? Some people have very large portfolios with dozens of companies. I tend to have a much more concentrated portfolio with, I have under 20 companies total in my portfolio. So I have bigger bets on a smaller number of companies. Now, and most of those companies are in drug development. So the areas that those companies are playing around in and the industries they're in also affects how to answer this question. In drug development, yes, for early stage companies, you're going to have some of your winners are just going to really make up most of the gains for your portfolio. And then you're going to have some maybe that are just don't work out, right? The thesis completely breaks down and, it's going to be really sad to own those. There's really almost no middle ground. I don't think there's a whole lot of drug developers I've ever owned that just track with the market, because that's not how they are valued at all, right? They're valued based on these de-risking events. So I think in 5 years, there's going to be big winners that make up for any of the losers on my scorecard. I don't think there's going to be much middle ground, and hopefully I can avoid as many of those big losers as possible. But definitely it's going to take some time. Next month is my 12th pick, so it's my 1 year anniversary really of being at 7 Investing, and none of my companies yet have crossed the de-risking event. There's one that's supposed to be any day now, So like, it takes time for these companies, and same with Steve, with early stage companies, and you just have to accept much higher risk, and some of those might not pan out.
So I also do something that's a little bit different. I know we track against the S&P 500, which is sort of the industry standard, and that's largely because you could buy shares of the S&P 500, but I don't look at it that way because I was never going to buy shares of the S&P 500. So, and I will point out, I have a stock on our scorecard, and if you are a member, you can see what it is, that is worth significantly more money than since we bought it. It's double digits higher in the handful of months we've owned it, but it is dramatically underperforming the S&P 500, in that weird snapshot of time. That's why I don't worry about it, because my stocks aren't necessarily connected to what the overall S&P 500 was during that time period. So if I said to you, Max, you could spend $100 on a stock and have $130 a year later, I'd be happy with that, even if some phantom investment I didn't make in an index fund might have returned better than that. So I actually think it's really way more important to look into total returns, unless your consideration is I'm going to buy individual stocks or I'm going to buy an S&P 500 fund. And even then, there are expenses, there are tax things, it's not an apples to apples comparison. I understand we have to use the metrics that the rest of the industry, but I would argue that if I tell you to buy a stock and that stock at the end of the year has made you 15, 20%, that's pretty good, no matter what the S&P 500 has done. We've got a lot of questions here. We're going to try to get through these. We appreciate you guys waking up towards the end of the show. SD, and I assume this is pro wrestler SD Special Delivery Jones. Actually, I think he passed away a few years ago, which is a good guess for any professional wrestler I remember from the 80s. Off-topic question. Do you usually wait until the lockup is over to invest in a company? I do not buy early stage companies unless I've been following the company as a private company. So not one I can answer, but Steve, I'll let you go. And then Max, you can finish this one up.
Yeah. Those of you who followed my official recommendations at 7 Investing know that I've recommended several companies before their lockup periods have even expired. So lockup period, a lockup expiration is a period after, basically a set period after the IPO or after a prospectus is filed to actually go public, after which insiders and certain executives are legally allowed to sell their shares. That's what they mean by lockup periods. So usually there's a lockup period of anywhere from 90 to 180. For some SPAC companies, Simon and I were talking about this on our last podcast, sometimes it's up to a year. And sometimes there's no lockup period for certain investors. So you kind of have to dig into those details. But I don't particularly worry myself too much. And in some cases, I'll use any weakness surrounding lockup periods as an opportunity to open or add to positions in companies. But it's not a primary consideration for me. And it's, in some cases, this lockup period expiration weakness just never materializes. So much ado about nothing in a lot of cases. So yeah. I'm not too concerned, but it is something to watch.
Steve, it's also important to look at percentages here. There are lockups that could be a relatively irrelevant part of the float, where they might be life-changing amounts of money to those people. And look, I would expect if I have stock in a company that I work at, when that stock ends the lockup, I should sell enough so if things don't go well long-term, I've made some money. So maybe I sell 5-10% of my holdings. It is also a telling sign if all the insiders sell off all of their holdings. Now, if those insiders are, say, hedge funds or people that this was the liquidity event for them, I get it. But if like the CEO doesn't hold any stock after it, that is a red flag. Max, this can be very different. You can be at a very stock, there could be a lot of stock locked up during a biotech run up here.
Actually, it's the opposite. Once again, drug developers are different. There's usually not a big issue with lockup periods. Insiders, like executives and so forth, don't usually own a whole lot of drug developer companies. It's usually like in the low single-digit percentages, maybe 10%. Is that
because they need so much cash before they can go public?
Yeah, so the liquidity events, usually like a venture capital fund will be cashing out, and there's really it's a different lockup period, right? So like they'll cash out at the IPO. Like you said, that's the liquidity event. So not usually a big issue for early stage drug developers.
We appreciate your questions here. Again, you're all late to the party, but it is still a party. Roman, we are going to take that question next here. What rate of return are you aiming for over a 5 or year time frame? I don't think of it at all. I pick winners and I hope they win. And unless something changed, I gave a little bit of rant earlier that retailers have not been tracking based on results, that you get amazing results and someone goes, I don't know that they'll do well next year, and then it's down 10%. That to me doesn't matter. So my horizon is way longer than 5 to 10 years. I don't put a number on it. Steve, is there some number in your head where you're happy, or is it just good companies hope they do well?
No, I mean, I do obviously. I hope to outpace the broader indexes, of course, because why are we stock picking if someone could otherwise just buy a low cost index fund? But I mean, obviously, I'd like to beat the market, but again, not that big of a deal if we're making money. And over a 5 or 10 year time frame, it's kind of tough to predict your exact returns. But for historical perspective, the S&P 500 for the last 115 years is averaged at roughly 9.8 or 9.9% return, which is pretty strong. If I were to achieve at least a 20% annualized return over the next 5 or 10 years, I'd be pretty happy with that. But I do hope to significantly outpace it.
Steve, am I
don't set I'm not going to say like 30% or I'm upset. That's
I like how every time you think Steve's done talking, he adds another paragraph
bringing together
next to what he's saying. It just keeps going. Just keep going.
I just want to weigh in with one thing here, Steve. If I remember correctly from when Tesla got involved here, the S&P 500 is a weighted index, right? Meaning the bigger you are market cap, the more they have to buy. That can be skewed. So just Tesla, and somebody is looping back here. So Max, that might be you. Yep, that was you. This might be a case where if you take one top performing stock out of the S&P 500, you're actually way outperforming. So again, if that's something worth looking at, because Tesla would have skewed, at various periods had it been a member. Apple could. So you might own some of that company and own a lot of better ones and go, okay, S&P 500 minus Apple and Tesla, my companies are outperforming that. That's a very tricky calculation. I don't even think you could actually do that calculation. Maybe a Nearbot could do it. We couldn't do it. Steve, go ahead.
You can calculate it. And I've been kind of noticing that actually incidentally in recent months. There's been a fair disconnect between the performance of the broader indices and the majority of the companies underlying them. It's been a few big outperformers that have really resulted in a significant chunk of the broader index's gains. And so there's a strange disconnect, where you see it's something like 3/4 of the companies in this index have actually declined, but a quarter of the companies are making up all of its gains. And so I think that's a little bit of what we've seen in the kind of recent pullback. And it seems silly to that I see so many people panicking on social media over a 2% decline in the index, but I think it's healthy, to see these indexes kind of consolidate a bit.
People lack perspective. Somebody might own something like Zoom, which obviously we covered early in the show, and maybe it was up 600% since they bought it, and then it pulls back 30%. So it's still up some fabulous number. It's just not, and I get it. Financially, I understand that. It's money you felt you had that you lost, but that ties into the last question we're going to take here. And this is from Stock Investor. Max, you're welcome to read this one out loud and give the first answer here.
At what point would you trim a big winner? 10%, 20% of your overall portfolio? I'll go first. I actually don't usually trim winners at all. I just pick more winners, Stock Investor. That will dilute your top holding and make it a smaller allocation of your total portfolio. So this is a personal question. It depends on how you allocate. I tend to, if you trim winners, that's usually one of your biggest regrets as an investor.
Right. Yeah, I'll give an answer we've given a lot. I don't trim winners either. I may stop putting new money in them, but I may not, because I might still see it as an opportunity. That being said, if something, and this can be a bigger thing for newer investors, is something is so much of your portfolio that you feel you have to check it 3 times a day and it impacts you sleeping at night, losing some upside might be worth trimming that position. You have to think of your overall mental health. And we've seen your really solid companies. The one I always bring up is Microsoft. Microsoft has dropped more than 50% in the last 10 years at one point and has since recovered, and probably more than 30% at least a few times and recovered. If that's going to send you into a tailspin or a depression, then you might not want to have 50% of your portfolio in that because you bought it at the right time. That is a very personal question. And I think we probably have a higher risk tolerance than most in terms of not trimming. But again, the other one I talk about, and this is uniquely true for retail, and we sort of talked about it with Moderna earlier. If I have a retailer that the reason it's grown so much is it's executed really well and it's sort of reaching the end of its strategy, and anything new they do would just be starting from zero and they'd have to have a new concept, in theory, that might be when I start to trim or sell. I bring that up, but it's never happened. I have not seen a really good company saturate the market and not come up with some other new concept. As soon as they finish building out all the Starbucks and focusing on the grocery stores, well, they'll figure out premium or the Starbucks blimp or the Starbucks amusement park or whatever it might be. I haven't thought of it. Starbucks amusement park sounds like a great idea. That would be one amped amusement park. Steve, your thoughts are, I did point out earlier today on Twitter that I would rather see Starbucks The Line than the Jungle Cruise movie. And that, of course, Starbucks The Line would be a movie based on the 45 minutes I spent in line at Disney watching people who apparently had never been to a Starbucks order coffee and ask questions like, what's a cappuccino? So that being said, Steve, is there a point where you trim a winner?
Not really. I'm not too concerned. I'll kind of reevaluate if I have, something that runs up huge and all of a sudden it's 80% of my portfolio. That's I'll tilt my head at and say, should it be? But actually, for those of you who go to 7investing.com, if you search for if you search how should I allocate my portfolio, there's a great FAQ article that will pop up, and I link several. When I last updated it, linked several articles that each member of our team wrote on the topic of portfolio allocation and how we think about trimming winners and how we allocate to begin with. And there's some good articles in there in that FAQ. How should I allocate my portfolio? Find that article on 7investing.com and just take a peek, and you can get a much more detailed idea of how we each think about it.
There is an amazing amount of content, both member-focused and free, on 7investing.com. We are working on making it easier to discover it. We, of course, have search through Yext. That is a work in progress, but it helps you find some things. If there's something you think we have and you don't know where it is, you can email us at info@7investing.com, especially if you're a member. If we've talked about something on air and you can't find it, we will help you chase that down because we are usually more likely to know where it is. And I apologize, Steve, that I just created more work for you. But again, if you want to let me into the email, I'm more than happy to do that. That tends to be Steve and a little bit of Max's domain there. We are rapidly running out of time because we had a flurry of last minute questions. So Sam Bailey, it's a bit of a loaded finisher. Let us hit our finisher here. Which industry will get back to pre-pandemic levels fastest? About 18.6% said airlines, 13.6% said hotels, 59.3% said restaurants, 8.4% said ride sharing. One of our friends pointed out that there have been points during this where the airline industry has, quote, gotten back to normal. But those were actually like holiday weekends that just sort of were very abnormal pent-up demand. I would argue here that airlines are actually going to be last. And that's because my version of normal is you run all your routes. I don't have to take 16 connecting flights. My flight doesn't change 15 times. I was supposed to go on a cruise in Bermuda. The cruise was canceled months ago. At some point, my airfare got refunded, but for like a month, I got every day like 2 notices about how, and like sometimes it'd be great, like, oh, you get there an hour earlier, and I was cutting it really close. So, and then sometimes it was like, you get there 2 hours later. I'm like, well, that's not going to work. The ship's not going to be there anymore. And that made less sense even after the trip was canceled, and they kept sending me that. I think airlines, except Southwest, which is having its own growing pains, and JetBlue, and maybe, there's a few other little ones out there. They have really put themselves in a bad position. And I saw some people questioning, what did you do with all the billions of dollars we gave you? Why do you not have enough workers ready to go when airlines collected something like $54 billion? Why are only Southwest and JetBlue in reasonably strong personnel and aircraft positions? I think that's something we should ask. Restaurants are struggling. And Max, I'll let you weigh in a little bit here. Steve, restaurants are struggling. And there's one misconception I want cleared up. It is a political line to say, well, until we get rid of the added unemployment, nobody wants to go back to work. Here in Florida, we got rid of the added unemployment. And a lot of people have either just decided, I don't want to go back to the restaurant business. This is a difficult business. I'm going to look for something else. Or they don't have childcare. And that is a real problem right now. So I hate to get into the politics of anything, but be really careful when you're not trying to be political and you sort of parrot a political line. I'm not saying that in Massachusetts or places that still have enhanced unemployment, that there aren't some small percentage of people that are like, ha, I'm taking advantage of the system. But for the most part, I've talked to a lot of bartenders and a lot of waiters over the last few months. People want to get back to work. Steve, any thoughts on this one?
Yeah, I'm tempted to vote restaurants, but I think there's some nuance there and perspective in order in that a record number of restaurants closed their doors permanently during the pandemic, right? So normal might be a relative term for the restaurants that survived and have actually come back, and maybe they will rebound strongly. But I've seen articles about the restaurant industry in California saying we expect it's going to take years to get back to normal, quote unquote. So maybe something like airlines will surprise you and beat everybody to the punch. I've never really been bullish on the ride sharing industry anyway. And hotels, I think, are correlated to airlines and travel in general. So it's kind of hard to say. I don't know how to
I think hotels are more nuanced.
Yeah.
So resort and tourism hotels, especially regional and local ones, the property my wife and I own, which is in a resort in the greater sort of Disney area, we're sold out every day that we're not staying there for July with mostly local tourists, because rental cars make people that aren't local have to stay on property because it's on Disney property because it's easier to get around. As those things lessen, I fully expect we are not going to have any trouble August, September, like for the next 8 months, maybe renting out our place. We already have it booked for like full months coming in the fall. And again, we stay there sometimes. So it's not, so I think those hotels will do well. I worry a lot about my favorite hotel in Alexandria, Virginia, the Westin, home of the Trademark, which is a very lovely bar that I've spent an enormous amount of time meeting with people at or hanging out with many of our mutual friends. That is a hotel that has some tourism parts of the year, fills sometimes with political things because it is very close to DC, but is generally dependent on the business in that area because it is not on the downtown street where there's lots of other hotels where all the restaurants are. So I do think we're going to see business hotels that are not in a location to pivot to non-business may really, really struggle because the offices that are in that area, some of them are government, and those people are back at work. Many of them are not fully coming back to work. And things like, hey, come in for a meeting. I think most business travel is still going to happen, but there's a lot of office visits that aren't going to happen because the people you would have visited aren't in the office anymore. Max, do you have anything you want to add in here?
You guys did a great job with all the nuance for each of those. I don't think I can add much. I think ride sharing actually might return faster because it's one of those habits that people will just feel more comfortable if they're vaccinated. Just getting in some stranger's car and for the convenience of it. I can't really add anything to that.
I wonder about that because there's a dual problem right now with rideshare. As more companies are paying $15 an hour or higher, rideshare becomes less attractive for someone who's just doing it for income purposes. Still attractive for the person who's doing it for flexible hours or as a way to make extra side money. But if I can go work at really good companies and have an upward career trajectory, there's less drivers. How do I know this? Before my canceled Delta flight, I was supposed to take a planned Uber, and the planned ones do cost a little more, from my house to the Palm Beach International Airport because I was going to be gone for 6 days and parking my car for $28 a day didn't make sense. And parking at an offsite place that would be farther than my house didn't make a lot of sense. So for the 2-mile trip, Uber wanted $35 and I booked it. And then when Delta canceled me or did whatever they did with my flight, I had to cancel it. And guess what? $25 cancellation fee, which is fair because that driver had to plan to work at 2:45 in the morning or whatever ridiculous time, 3:45 in the morning, whatever time it was. I actually think rideshare and food delivery is going to collapse and become something new. It will exist. We want to get food from every restaurant delivered. We went through this in the 80s where for a while there were all these like phone numbers you could call where like they would cobble together your order from like 10 different places and it would show up like I don't know, like 3 years later. Like it was just a terrible system. We have a terrible system right now. It's not viable for restaurants. It is not viable for rideshare. I do think we'll figure it out before we have autonomous driving, but I don't think it works. We've gone too long. This was going to be a short show. This is now probably our longest show ever. I will say thank you to Sam Bailey, who I'm probably keeping from something more important. If you'd like to get in touch with us, that is info@7investing.com. That is questions about your membership, questions about our service. If you want to reach out to us on Twitter, that is @7. That is the number 7 investing. I will not take any more time. For Max, for Steve, for my mom who's watching upstairs on an iPad, for Sam Bailey, we will see you on Wednesday. Thank you.